Hey guys, welcome back. You're still tuned into Trading Hour. The market is still up with a 110-point gain that we are seeing. The banks also holding up quite well. It is almost 400 points higher on the Nifty Bank, but the mid-cap index is where you're seeing a little bit of softness today. So just around 0.25% in the green for the mid-cap index. But let's talk about some individual companies now. Union Bank of India reported a strong set of Q3 numbers with the best net interest margin and ROA that we've seen in 8 years. The asset quality also looked good. It came in at the best in 7 years. Abhishek Kothari earlier caught up with Ramasubramanian S, who's the executive director of the bank, and began by asking him about the robust loan growth that the bank has seen and whether they can really sustain it going forward. So let's listen into that chat.
There is always there's a good demand for the credit in the banking sector, and not only our growth, growth is on all sectors, including RAM and also in corporate sector. Corporate sector we have shown a growth of around 20%, and the RAM sector also not fall behind. It is around 17.76% as shown the growth. So we expect that with the presently, if you're looking at even at our credit growth, it is around 20%, and with our deposit growth is around 13%. We expect that there will be a little tightening of the rates, and we expect to reach around 12 to 13%, which is above our guidance rate.
One of the good part, as you mentioned, is that there has been loan growth across segments, especially the corporate portfolio. Now, in that corporate loan growth, are you seeing capex-based demand coming back, or are you still seeing working capital loans that corporates are taking? And if they are taking working capital loan, by when do you expect, the capex-based corporate loan growth to come back to the banking sector?
Yeah, actually, if you're looking at our growth and even whatever the availment, what we are having it is on both. We are having a project loans also as there, and there is a good availment in working capital limits also. If you are looking whatever the new projects, this is major. It is happening in infrastructure, where we have a good pipeline of HAM project and the road sector, and we are also very bullish with chemicals, steel, cement industries, where we find that there are a lot of availment in the working capital also. And going forward, we expect that not only these sectors are going to contribute, we also expect that there will be more contribution from pharmaceuticals and also from other ancillary units.
Well, net interest margin was at 8-year high for your bank, coming in at 3.21%. We know that, till now there has been the rate interest, which has actually helped in net interest margin on the yield side. So going ahead, as you mentioned that the loan growth will slow down, how do you see the net interest margin panning out?
Yeah, I'm not saying that loan growth will slow down, but there will be there will not be such a high growth you are expecting in the coming day. But anyway, we expect that there will be a continuation of growth in the credit offtake in the coming days also. But if you are looking at a NIM, literally speaking, there was it has contributed our latest rate hikes have contributed to the our NIM increase. And if you are looking at our advances, our credits have been carrying this hike more or less for the entire quarter, whereas deposits rates have grown under last second half of the quarter. So because of that, there is a little bit higher NIM is there. But going forward, we will be also looking at even in a loan portfolio, we will be looking at good NIM margin, and also we will be going and we will be trying to protect the NIM what presently we are having it. And anyway, we will be again guidance has been given for 3% for our NIM that will be reached.
In Q3, one of the best point in your result was the slippage ratio. The annualized slippage ratio was at 8-quarter low. So could you guide with respect to your asset quality or gross NPA ratio for FY23 and FY24?
If you look at it, presently we also have a very good system, and with our entire branches are looking at the containing the slippages, we are able to show a better results. And if you look at it, there is not much much bigger SME accounts in the corporate sector. So the slippages have to be controlled in retail and MSME. That is being done by the entire team at Union Bank of India, and we continue to do so. We will be trying to always, our guidance is our slippages will be less than the recovery and upgradation in each quarter-on-quarter basis.